We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Tim Price, Director at Price Value Partners and also the author of Investing Through the Looking Glass. How are you today, Tim? Thanks for joining me.
Great. Thanks for having me, Tom.
So, Tim, since COVID, we've seen a real explosion of government debt around the world, and I've had many conversations about how unsustainable it is on the show. Do you think that it's possible that really getting into a time here where the debt and, more importantly, a nation's ability to service that debt starts to come to a head here?
Yeah, I mean, as you say, this has been a long time brewing, but it does feel to me that as if we're literally on the precipice now. And it's not just any one market that's demonstrating that instability. Clearly, rates are going up throughout the world. They're going up in the US, they're going up here in the UK, they're going up in Asia, notably in the Japanese market. Japan finally has rediscovered inflation, which has been missing, absent without leave for some time. We had, because you have to slightly sort of revisit everything that you sort of assumed. So one of the things that was sort of assumed last year was that the spike in UK government bond yields during the Liz Truss administration was ultimately what drove her out of office. So we had one of the shortest lived prime ministerships in history. Mm-hmm. Gilt yields, UK government bond yields, are now higher than they were when Liz Truss was defenestrated. So there seem to be problems in bonds pretty much as far as the eye can see now.
So there was an article that I was reading, Tim. It stated that defaulting on the debt would instantaneously bankrupt probably the banking and pension fund industries of the world. So when we think about a nation, let's say, defaulting on its debt, it would seem that printing more money to temporarily quell a symptom of the debt issue, like we saw last year in the gilts market, wouldn't be an overt default, but wouldn't it end up resulting in the same outcome?
Yeah, we sort of, we're like people debating how many angels can dance on the head of a pin. I've long said, and probably the last time we spoke, I would have said there's really only three remotely possible scenarios for a government that's head over heels in debt. One is that government engineers enough economic growth to keep the debt serviced, assuming the government can even do that, which I think is questionable. But I think the likelihood of a government set recovery is absolutely not on the cards anywhere in the world. The second option is that we have effectively what we could call a default. They would never call it that. They'd call it a restructuring or a debt jubilee, but it would all amount to the same thing. And as you allude, that would basically instantaneously imperil, if not destroy, the capital of the banking and pension fund industry. So let's park that one as a viable outcome. What you get as a byproduct of all of this is then you get what's in box number 3. And what's in box number 3 is what's always been the chosen outcome every time governments have got, just thoroughly out of control, heavily indebted, impossibly indebted. And that's, you have an explicit policy of state-sanctioned inflationism. So it's no surprise that inflation is now basically front and center for everybody as a problem. They're probably understating the true degree of inflation anyway, so it's probably far worse than we're led to believe because they've always distorted things like CPI and, measures of inflation anyway. But you're saying this as an investor or was watching it as a consumer. If you're not uncomfortably aware of just how bad the price issue is, then you must be living under a rock.
So, as we think about inflation and interest rates, certainly it seems that with rising interest rates trying to combat this inflation, we've seen as a combined result of, let's say, the breakdown of supply chains and also the gratuitous money printing that we've seen. What do you see as the next knock-on effects that we have yet to see here?
I think the next development at the macro level may well be people anticipating some kind of Fed pivot. So far that the Federal Reserve has been acting like it wants to keep hiking rates until it breaks something. The US property market's probably already started to fracture at the seams. Mm-hmm. But the more we come closer to that tipping point where people think actually the next move is not going to be a hike, it's not going to be quantitative tightening, it's going to be yet more QE, that they're going to start to cut rates. I wonder if for the first time in history, when that actually happens, there won't be a relief rally. There'll be a wave of revulsion because people on the margin may start then to appreciate that there is just no way out of this, that the Fed's caught in a debt trap. in a similar way to what Japan's experienced. There's a letter that I often cite that I remember reading in the FT back about 15 years ago now. And it was from a Mr. Takashi Ito. And he was making the point that the Fed had become completely obsessed by Japan's experience during their bust years after the late 80s boom, when the property market and the equity market both went into free fall. And he said he finds this so ironic that, the Fed's so obsessed with Japan that the reality is, and I'm trying to think of the precise words he used, but I think in this letter he said, the harsh reality is that there is no alternative after a massive property bust but, quote, years and years of economic indignity, unquote. And I thought that was such a marvelously Japanese way of putting it, a very sort of floral way, a very sort of sweet and, almost poetic way of describing the harsh reality. We should have had a shakeout after 2008. We never had it. Where there was an opportunity for braver souls at the central banks and the banking system regulators to basically knock bank CEOs' heads together and sort out a problem. The reason we're in the mess now is because those hard decisions were deferred back in 2008. We know that they let Lehman fail, but on seeing the damage that one bank, fairly minor investment bank, let alone a commercial bank, had, they bailed everybody else out. But you do wonder if we might be in a far better state today if they basically let the systems properly reset back then. I think we'd be in a far better position now. But this is the problem. This is the existential nature of the problem for heavily indebted governments now, which is there is no alternative. They can't, well, they can, I suppose they can attempt to keep hiking, but they'll break something or they'll completely destroy something, and that'll be the property market, not least, and probably the bond market too. But the reality is there is no way out for these guys now, except ultimately to start at some point in the very near future going back to money printing again. Mm-hmm. And there, in that circumstance, they run the risk of completely destroying the currency system in the process. So there's no free lunch here anymore.
Well, we've certainly seen that, when Japan needed to start defending their bond market, it came at the expense of the currency. When they have to defend the currency, it comes at the expense of the bond market. So, could you see a situation in which Japan has to choose to defend one or the other and end up sparking maybe a daisy chain of events that affects the financial stability of many other nations around the world here?
Quite possibly. I guess the only thing that's different about Japan is that more so than most countries, the Japanese debt is owed to their own people. So the Japanese could effectively, quote, default, unquote, without there being so many international repercussions. But even then, the yen is still a highly traded currency, so there would be an impact. But if something similar would happen in the US, then basically all bets are off because, firstly, lots of investors internationally and central banks internationally own US government debt. And of course, everyone in one way or another is exposed to the dollar. So that would have probably far bigger, quicker repercussions. But everybody's in the same boat. It's only a question of degree. And the bottom line is, as an investor, if you don't have to invest in certain areas because they're clearly very risky, then the prudent answer is not to invest in those areas. There are so many red flags out there, and the bond market is the primary one.
So, Tim, from there, though, explain to us, let's say, a little bit about how you think that financial contagion could spread. Like, is it Japan, let's say, dumping more US treasuries to support the currency? And does that become a race between other countries to sell more treasuries? Or is there another mechanism there that could come into play?
Well, there is an expression that if you're going to panic early. So the first country to bail on the US debt situation is probably going to be the best placed. Mm-hmm. Like you said, things are so uncertain, things are so unstable now. It's difficult to know how things perhaps might play out. But I can certainly foresee problems. The US is in no position to be making the geopolitical bullying maneuvers it's been making for the last 2 years. It's behaving as if everybody's queuing up to buy its debt. And the reality, that's not the case. I suspect that China's been quietly divesting itself of its US Treasury assets for years. So it's not the equivalent of, say, Japan, which has got a bucket load of this stuff sitting on its balance sheet. Mm-hmm. The other thing that we sort of spoke about before we came on air is the extraordinary policy drift of the Biden administration that, to repeat, after the Russian invasion of Ukraine, decided it would be a really good idea to levy sanctions on Russia. And only after the fact did it then perhaps come to appreciate that in doing so, it had basically sowed seeds of doubt throughout every unaligned or non-aligned country on the planet, thinking, do we really want to trust the US dollar anymore? Do we really want to trust treasury assets? And as a friend of mine pointed out at the time, fairly early on into the Ukraine conflict, that even at the height of the Second World War, a hot global shooting war, even at the height of the Second World War, the Bank for International Settlements, the BIS, the so-called central bank for central banks, they always honored and respected German reserves held overseas. Whereas here we've had fairly soon into a conflict that was in large part triggered by NATO's misbehavior. You've had the Biden administration basically arbitrarily seizing not just Russian sovereign assets, but even Russian individual assets by, say, oligarchs, if you want to call them that. This behavior is pretty much unprecedented. And if it was designed, to kowtow people into compliance, it's going to have exactly the opposite effect. So now, as you know, we've got this huge question mark arising over the rise of the BRICS, or the BRICS or BRICS 2. And this couldn't be happening at a worse time, given the funding requirements of the US government.
Yeah, that's a great point, Tim, because, having that ability to sell your debt on that to everyone else, to export your inflation as the US has for many years, I think, you said it perfectly. It's coming at a horrible time.
So I think that the days of exorbitant privilege are basically over. And the great bargain that was agreed was the bargain between the US and Saudi Arabia in the early 70s, when the US effectively offered, by all accounts, to offer military protection and sponsorship for the Saudis in return for the Saudis agreeing to accept US dollars for terms of trade of their oil exports. That relationship is also fracturing at the seams. So all of these certainties that we've used to living with for the last 40, 50 years, they're all shattering at once.
Do you think that ends up creating ultimately more inflation, or has the inflation genie been put back in the bottle by, everybody raising rates and quote unquote being so aggressive with their fight against inflation?
I don't see how an inflationary problem of egregious, overly excessive money printing can be remotely dealt with by simply sticking up policy rates, because there was clearly an effect of having ultra low rates for far too long. I don't dispute that. But the primary reason for inflation at any time, anywhere, is a result of money printing. So it's not a result of arbitrary over borrowing by consumers or by corporates. It's because the central bank is just thrusting money into the system that isn't really required, and all that's happening is everyone's losing purchasing power. So I don't see how the inflationary genie can possibly be corralled back into its bottle. I think it's more likely that this seems to me, and I'm not trying to scaremonger, but it seems to me that we're closer to a systemic crisis, not just over inflation per se, but over the entire validity of the currency system now. That on the margin, if people don't need to own currency X, Y, or Z, currency X being, in this case, US dollars, then they'll own something else. And that something else might be another currency in fiat terms, or it could be Bitcoin, or it could be gold. Mm-hmm. But we know that central banks have been buying gold with abandon for really as long as I can remember now. So I think the free market answer to this conundrum is somewhat clear, and it's not going to reflect well on the dollar.
Yeah, as Luke Roman puts it, it's that bubble just keeps getting kicked upstairs, and now it's at the sovereign debt bubble level.
Exactly right, and that's exactly why sort of the failure to grasp the nettle back in 2008 is such a problem, because the problem with the banks back then was a corporate level problem, and because the banking system itself didn't have the liquidity or the reserves to handle it, it got shunted up to the sovereign level. But what we're now dealing with is a problem on multiple fronts at a sovereign credit level. And there is no entity in the world that is capable of handling this situation. We need to have some kind of, extraterrestrial central banking facility to get us out of this mess. So it's not going to happen. So ultimately, something that can't go on forever will not go on forever. And I think we're that much closer now to potentially some tipping point. I think we will see some form of monetary reset. What I'm hoping against hope is that reset will ultimately be led by something resembling a free market, and not by what clearly the central banks wishes to impose, which is central bank digital currency, which is a form of money that I think only central bankers want. I don't think anybody else on the planet even wants them. So that, for me, the 100 trillion question is, what form does the reset take? And at the moment, there are lots of balls in the air, and it's unclear as to how and where they're going to land. But ideally, and I accept this is wishful thinking, ideally it's a free market solution and not a statist central bank directed one. In an ideal world, central banks will fail to survive this mess because they're the people responsible for it.
So, Tim, when we're facing a proposition basically of higher inflation here, and also, as you're saying, very likely a sovereign debt crisis or a major financial system collapse, do you think about those two outcomes as having a different solution for your and your clients' money? Or are they to take a defensive stance against either one ends up being kind of the same way to protect yourself in either case?
I mean, I think it's said that in religion there are sins of commission and there are sins of omission. Mm-hmm. I'd suggest that the issue for us, let's assume for the sake of argument, you're completely unconstrained. So you can basically buy anything you like. You're not beholden to indices. You're not beholden to a rigid asset class allocation. So you can buy whatever makes sense for you. In that environment, and this is the way we're thinking and operating at the moment and have done for some time, bonds as an asset class are uninvestable. It doesn't matter what yield they offer because we don't ultimately trust the underlying issuers to make good on those payments in real terms or in nominal terms. It's academic now. So if you accept that there's too much credit risk, counterparty risk, inflation risk, systemic risk in debt, then you don't own bonds, full stop. The same argument basically pertains to cash. So if you're really concerned about credit risk, counterparty risk, solvency risk, all these kind of issues, you don't have large amounts of money sloshing around on deposit. You have them in some other form. Now, there's no free lunch here. So there's no, quote, safe, there's no perfect solution. You have to accept there's going to be price volatility with anything. But that's the nature of the game we're playing now. If you discount debt as a solution, you effectively are discounting cash as a solution too, because it's as a manifestation of the same thing. And you're also discounting naked fiat currency exposure. So by a process of elimination, what that ends up getting you is a binary decision between favoring real assets over paper ones. So you want to own, we think, shares in the productive economy, claims on the economy, things that have tangible value, things that are inputs to the ultimate output that is GDP. And those things will be, in no particular order, things like gold, silver, precious metals, commodities generally, mining companies that are profitable and have little or no debt. All of these things kind of work. That's not to say you'll instantly make money from owning them, because if the proverbial is going to hit the fan at a global level or even just at a national level, one of the larger economies, that's going to have an impact on equity prices. But if an investor has selected the right kind of businesses, there will be something left, once the dust settles. The concern we have as a business is that if we choose wrongly at the asset class level, there may be nothing left at the end of the day, because the world suddenly starts looking a little bit like Argentina, or it starts looking a little bit like any of the European countries that have had big debt problems over the last 15 years during the Eurozone crisis. The problem with a debt-based issue is ultimately currency related, and you can wait, and it's a cash problem too. So you can go to bed on a Friday night with 100x in your account, and then find that by the time you've woken up on Monday, they've arbitrarily taken 10, 20, 30, 40, 50% of your X, and you're left wondering, I never saw that coming. So rather than even have to worry about that eventuality, we'd rather own something altogether different. We'd rather have a claim on the real economy, and we'd rather have the property rights that come with equity exposure, rather than just being beholden to an untrustworthy issuer of debt.
Mm-hmm. Tim, I recently listened to an excellent podcast that you guys did on, the name of your guys' podcast is the State of the Markets podcast.
That's correct.
And one of your guests was arguing that gold is no longer of interest to him because it's now just a commodity. So what arguments have you heard against owning precious metals like that?
I get the argument, and this would be one advocated by people like Warren Buffett, that it's basically inert, that 100 ounces at the beginning of the year is only going to be 100 ounces at the end of the year. It doesn't pay you any natural income, but then neither do dollars, neither does pounds sterling or euros or yen or renminbi. The only way you can convert your currency into an income-producing asset is by turning it into a deposit with banks. So you're having to take risk one way or the other, and gold clearly frees you from that. Get the argument that there's no natural income, so gold ought to be underperforming in a period of high and strongly rising interest rates. The reality actually is that gold has performed extremely well in most currencies, even in dollar terms, during this rate rise sequence that we've seen recently over the last 2 years. And even in dollars, gold is only a few percentage points from its all-time high. So a lot of these arguments don't seem to hold any water anymore, or not as much water as they used to. But I think that there's a contextual aspect to this that, as I may have said earlier, one of the questions we get from clients a lot is, at what point do we consider taking profits or selling, for whatever reason, our holdings in bullion, in gold specifically? And that assumes that there's some kind of arbitrary price point or dollar point whereby it makes sense. What that doesn't take account of is the fact that if we will look to sell or to take profits in our gold when the circumstances which caused us to buy it in the first place have been resolved. The reason we own gold is not because we're punting in commodities prices. It's because we are so acutely concerned by the instability and the possible insolvency of the global debt market that gold is a natural hedge against that outcome. So the question can be more fairly articulated as, at what point do we sell? We sell when the global debt predicament has been resolved. Unfortunately, since the last time we spoke, the global debt predicament has, if anything, got worse, and it was pretty bad the last time we spoke. So, like I say, we seem to be on the edge of a precipice here. So the thing we're probably most, within the business, we're probably most confident of is that we're going to see far higher prices as expressed in fiat currency terms for a lot of the things that we own. It's taken a longer period than we anticipated getting to this stage. But these problems, as I say, have been brewing for decades, and we don't want to be bullied out of positions ahead of them really coming good. So that's the situation we're in. And those are the answers to the questions over how do we see the debt problem playing out. There's so many moving parts. It's impossible to state with any degree of certainty how things might play out. But to use the metaphor, and this is quite a common metaphor in the markets. Let's say you're on a ski slope. You don't know which flake of snow is going to cause the snow mass to become unstable. All you can do is acknowledge that at some point the snow mass is an unstable thing that could collapse and cause an avalanche. The only thing you can sensibly do as an investor is acknowledge that there's been a phase shift from stability to instability and play another game and have nothing to do with the snow anymore. Right. I think that's where we are in relation to debt markets now.
Mm-hmm. Tim, when we're facing this mountain of debt, it really seems like having something to invest on the other side of that would be really important. I came across an interesting quote doing research this morning for this conversation, and it was that possibly the most important driver of an investor's returns is actually when they were born rather than the actual sectors that they invested in. Is that in a way part of the problem as well? Is the time when they start investing?
We are all basically a victim of our historical circumstances, so our historical experience. So I think that point is absolutely correct, that who you are as an investor is in large part a function of when you were born and what you experienced. I wouldn't dispute that at all. I guess the trick is trying to see through the personal experience and try and see a bigger picture. So if I look at the world that we inhabit, which is largely unconstrained as investment managers, so we invest in value stocks, and that's basically cheap, high quality listed businesses, end of story. And they're always going to be in vogue for us because that's what we do. We're value managers. We invest in systematic trend following funds, which an intriguing trading vehicle for people who aren't familiar with them. The trend following funds for us have now replaced debt instruments in our portfolio. So whereas we say 10 years ago, we might have held bonds or government bonds, only ideally issued by creditworthy entities, and there aren't that many to count anymore. Nowadays, for the last at least 5 years, we've been investing in trend followers instead. And I don't know if your listeners will necessarily be familiar with trend funds, but I'll just have a quick diversion. 99% of managers try and predict the future, and most of them do a pretty bad job. There is a 1% of the fund management universe that doesn't attempt to predict the future. It simply mechanistically responds to the past by way of the price history of financial instruments, and they're called trend following funds, systematic trend following funds. Systematic because they have a system, they have a process. So that process might be, for example, if X trades at a new 52-week high, then buy a unit of X. If Y trades at a new 52-week low in price, then go short a unit of Y and then manage that position accordingly. And where this completely differs from most managers is that most people will naturally gravitate towards the thinking that if something's reaching an all-time high, it's too expensive. And if something's reaching an all-time low, it's attractive. But a trend follower has exactly the opposite perspective on life. They're saying, as long as it's going up, I want to own this thing. And I put in a stop loss to protect me against a sudden change in market direction. And if something's trading at a new low, it may well go lower. So I'm going to short it. And as a result, you have this strategy, or maybe it's fair to call it a multi-strategy approach. These type of funds trade equity indices, currencies, hard commodities like zinc and copper, soft commodities like corn and wheat. They trade all kinds of things. If it's going up, they'll buy some. If it's going down, they'll sell some. And so they can be long and they can be short, and they can be short just as happily as long, which again makes them in the minority compared to most managers. As a result, they're hugely diversified. At any given time, they're typically only about maybe as little as 50% invested or less than that. So most of the money they got parked in T-bills. But when their system identifies things that are strongly trending in price, they trade accordingly, and they'll pyramid in and out of positions. And there's quite good risk management attached to this. That to us is a far more attractive route for, let's say, ensuring part of a client portfolio than bonds will ever be now, certainly for the foreseeable future. And you talk about, people's historic experiences, but trend following funds have some of the best long-term track records of any instruments we know. So some of the managers we use have been doing this for 40 years plus, and they're still cranking out great returns. And the tragedy is it's a type of trading approach that virtually nobody's ever heard of.
I was going to say, as long as I've been doing this show, I haven't heard it explained quite like that. That is quite interesting.
We love these instruments for a number of reasons. One is that we would argue they have a good claim to being historical, bellwether, safe haven type investments. That's not to say they don't lose money. They do lose money. And the more aggressive trend following funds can lose quite a bit of money quite quickly. But for a typical trend following fund, a bad year is a down 5% year. It's no great shakes. But a good year could be over 100%. So the most aggressive trend following fund that we use made over 100% in 2008. And that's really what you want. What you want is an uncorrelated return stream. You want a return stream that's completely unlinked to the stock and bond markets, because that's where the problems are going to arise.
Right.
So that's something I single out. And then the point about historical experiences is also valid on the bond side. So we don't invest in bonds for, I think, what are probably now completely obvious reasons. But I think a lot of managers right now, either on a regulatory basis or just through personal conviction, they feel obligated to own this stuff because it's been such a good performer. But there's a chart we use in our presentations. We've had 40 years of declining interest rates in the West, but the problem goes deeper than that, because the chart we use goes back about 5,000 years, and it's via the Bank of England and other price sources. Interest rates bottomed about 2 or 3 years ago at their lowest levels in all of recorded history. And from that point, they've started to rise. And you can say one thing with absolute certainty in relation to that. If interest rates rise, let alone from all-time low levels of zero, or in some cases even below zero, if interest rates to rise from their lowest levels in 5,000 years, bad things happen to financial assets. Mm-hmm. Bad things happen to bonds. We've seen that already. We saw it last year in spades. And bad things happen to, in some cases, stocks, but certainly to property. And people are unaware, because to your point about, this piece about historic example, everyone's used to a period of almost effortless prosperity the last 40 years, when you can make money by owning bonds, you can make money by owning stocks, and you can make money by owning, if you take the more recent decade, it was only a one decision thing. You owned the US market. More specifically, you owned the so-called FANGs. You owned Facebook, Amazon, Apple, Netflix, Google, and probably now Nvidia. It was a one or two decision environment. That environment is coming to an end now. So all the people, I think, who are looking out of the rearview mirror, they run the risk of being vaporized when the market really goes south with any conviction going forward.
Mm-hmm. You mentioned that you want to own income producing businesses that are cheap. So how do you go about deciding if a business is cheap?
I mean, we're Ben Graham style investors, so a lot of this stuff isn't new by any measure of means. Ultimately, we use Bloomberg to screen for companies that are cash flow positive, cash flow generative, hugely cash flow generative. So we want jam today. We're not satisfied with the prospect of jam tomorrow. We want to see the money being made today. And we're more or less completely agnostic as to which sector those companies are operating in. The reality today is that through happenstance, through sheer coincidence, some of the most profitable companies happen to be in the precious metals mining sector. So there's a chart I liberated from our friends at Incrementum. You probably know the company Incrementum in Liechtenstein. And this is a chart, for example, of median operating margins by commodity 2023. So on the far right of the chart, you've got agricultural companies, and they're making 5% margins, operating margins. Coal comes in at 13%. Oil and gas is 21%, which is, we're getting quite attractive now. Base metals is 24%. Precious metals is 27%. It's the most profitable bit of the coal commodities sector right now. And yeah, I don't think anybody's really aware of that fact, because, these companies are going nowhere. And I've got another particular favorite, again, liberated from the good guys at Incrementum, and this is market capitalization. So they've got one slide that shows you the market cap of Apple, which at the end of May was $2.7 trillion. And then you've got the market cap of every single company in the silver sector, the gold sector, the copper sector, the entire precious and diversified metals mining industry, and the accumulated combined value of all of those businesses is 1.7 trillion. Wow. So for 1.7, or for your 2.7, you could buy Apple. For 1.7, you could buy every single company operating in the precious metals and diversified mining space and have $1 trillion left over. These are incredible valuation disparities. We think, we may be wrong, but we think that the commodities market relative to the rest of the stock market in the US, say, is trading at levels we haven't seen for 60 years. So if we are right on this, and I suspect we are, these are the most attractive valuations mining companies have been at in my lifetime.
Yeah, really highlighting it that way is amazing, the way that disparity presents itself. Yeah, I've had Ronnie on the show many times and always look forward to digging into that massive report and all of the research that they put through it. And they've also been getting more and more commentary from other sides, like Luke Groman. I believe Lynn Alden did a piece in the last one, just to try to make sure that, they're not the only ones that are thinking like that.
So to your point about sort of historic experience, we would suggest that, and we're not alone in this, there's plenty of people who probably think the same way we do, that the fairest analog to the period we're now in as a historical one is probably the 1970s. So the 1970s, you had huge geopolitical shocks occurring left, right, and center. You had the Nixon gold shock, you had war in the Middle East, you had high inflation, you had union problems, certainly here in the UK, and I suspect elsewhere. So society was a mess. Inflation wasn't just inflation, it was stagflation. These all seem to be eerily familiar to what we're living through now, do they not?
Absolutely. As you bring that up, though, I go back to a conversation that I recently had with Lynn Alden. We really went through how inflation presented itself in the 70s. And I think, you bring up a lot of great points about the geopolitical instability. There are a lot of similarities, but I think that the big part that for me just clicked in that interview was that a lot of the inflation seemed to have been driven by this demographics explosion at that time, when a lot of the baby boomers came of age to buy houses and to furnish those houses, to buy cars, all of that idea. There was a massive spike in bank lending because all of a sudden everybody needed credit to be able to afford all of these new products. And when you think about it from a mechanistic standpoint, raising rates in that environment, not necessarily regardless of what else is happening, but raising interest rates seems like a very effective tool to combat demographic driven and consumer driven inflation. I think, as you said, there are a lot of the similarities here, but raising rates in this environment, I think, is an ineffective tool against the type of inflation that we're facing.
Oh, I completely agree. I mean, just thinking about it as an image, I just get the picture of a giant gorilla just beating its chest. So it's a sort of virility symbol, but it doesn't amount to anything. So the issue is, as I see it, that I'd take the sort of the Friedman perspective on this, which is that inflation is always and everywhere a monetary phenomenon. So the problem is the inflation's baked in because the inflation is the quite gargantuan issuance of ex nihilo money that's been pumped into the system that had nothing to do with consumer demand. So it wasn't baby boomer led consumption. It was central bank supplied inflationary foam. It was bubble money. Mm-hmm. And so it was worse to the extent that it was shoved onto the system at a time when the economy was in a hard shutdown through lockdown. So you completely distort both supply and demand. It's no surprise we're in the mess we're in now. I think in terms of sort of trying to square the circle as to why we could yet end up in an environment akin to the 70s, it would be probably, I think in extremis, it will be because we may yet see something akin to what Ludwig von Mises, the great Austrian economist, called the crack-up boom. And the crack-up boom is that environment that occurs when the average man in the street starts to realize he's being bilked by central bank activity. Mm-hmm. Everything's being inflated away quite deliberately because it's the only way they can keep the debt system show on the road. And it comes to that point where people think, where the average person, not just big investors, but the average person thinks, I'm going to need to do something with my money here because it's being evaporated through inflationary fire. So people start to convert their increasingly useless money for real goods and services. So there's a rush to real assets. I think that is one way that potentially this, however many months or years ahead of us, it's part emulate the 70s experience. It's because there's a crack-up boom mentality sets in. And as we sort of touched on earlier, the crack-up boom is also consistent with a collapse in confidence in currency.
You know, Tim, as we're talking about these problems and all of these moving pieces, as you said earlier, that are impossible to kind of figure out where they're going to end up lying, I think an interesting concept to try to understand is the distortions that a lot of this cheap money in the system has produced within the markets. I'm sure we'll go through a couple examples here, but you know, ESG investing has been this theme, and there has been a major rise in this real fancy and popular keyword that seems to really encompass everything from being the justification for debanking somebody like Nigel Farage, for example, to firing other people. So do you think that this ESG movement was spawned in part by so much cheap money being injected to the system and the inability of the free market to make the choices that ultimately would be very likely best for all of the economies around the world?
I'd say this, for me, there's two aspects to the ESG, the rise and what I hope is now the decline of ESG. One is that it seems to have arisen from desire to impose, for want of a better phrase, is cultural Marxism on the world. That there's a woke green agenda to sort of quietly behind the scenes on this. And I think the other aspect of it is that it's basically being led from the top by, let's just say, extraordinarily large asset management businesses. So it's no secret that BlackRock has almost single-handedly shoved the ESG agenda onto people. And quite rightly, people are now beginning to sort of gag on being forced to chow down on this stuff. So the fact that you have now Larry Fink himself backtracking on the whole ESG model, I think is delicious and long overdue. Mm-hmm. I've always been, at a personal level, I've always been resistant to this stuff, not least because it's completely arbitrary. It's entirely subjective assessment of, of perceived value or perceived superiority. That you have some companies that are deemed to be ESG favorites, and I dare say they'd be inclined towards, alternative energy makeup, for example. And then there are some companies that would be on the other side of that spectrum. But the whole green agenda, the whole green industry is not what it seems, because electric cars are not as good for the planet as we were led to believe. They involve mining very toxic substances out of the planet. A lot of that mining is done by small children as slave labor. I find that difficult to square as sustainable ESG policy. Mm-hmm. And the other one would just simply be China itself, that if you're a fund management company investing in China, you do not have a credible ESG policy worthy of the name. So there are all these subjective aspects and inconsistencies. The whole thing's a joke. But you could argue that the main reason for ESG was simply nothing more than the fact that the fund management industry needed a new narrative to sell, a new way of flogging funds, and ESG provided that. Mm-hmm. But I don't think it was a market-led outcome. I think this was driven by a political agenda. It was not driven by free market. People saying, you know what, we really need an ESG fund, because people are crying out for it. It arose more as a top-down diktat, as a quasi-Marxist phenomenon.
Well, that's what I was going to say is, if we are starting to see the downfall of it, as you said, Larry Fink has been backing away from it. Interestingly, S&P Global Rating Agency has also dropped its ESG scores.
We've had something similar from Vanguard today on the same topic as well. So
interesting.
The pendulum does seem to be swinging back. And for me, that couldn't happen too soon.
Yeah. So all I was going to say is, my point with bringing that up is that it's going to be interesting to see how this plays out ultimately. And as you say, if it was originally just a top-down dictate to the markets, then it is going to be shown, the veil is going to be pulled off the ESG face for what it was.
Yeah, I completely agree.
So, we've talked a lot about these topics, Tim. The markets aren't necessarily in great shape as they are. Normal people that are just looking at these issues where the S&P is at all-time highs, we're given so many of these narratives through our day-to-day existence here that it's hard to understand where to start drawing the line, and trying to understand that a lot of these narratives are very likely false. Like, again, the other example of maybe ESG was the best way to be investing money. So you guys recently had, was it Fergus O'Connor on?
Fergus O'Connor Greenwood.
Yeah. And he wrote the book 180 Degrees. And I thought that was a really interesting way of, like, number one, it was an excellent, excellent podcast. Regardless of the topics that you touched, I think it was excellent from the standpoint of just trying to understand how to have a conversation with somebody about the idea that it isn't necessarily about winning or losing an argument, but it is more so about trying to falsify certain truths that they hold, and to start, opening people's eyes to what they really should be learning about the world around us. So how did you, let's say, come about that conversation? What are some of the most important parts that you took from it?
So I think I came across Fergus O'Connor Greenwood and 180 Degrees through, I think I found, it was probably on Rumble, but it was an interview that he gave with a guy here called Richard Vobes. And I was sufficiently intrigued that I got a copy of the book, and the book is called 180 Degrees, Unlearn the Lies You've Been Taught to Believe. And it's a beast of a book. It's about 780 pages. So it's not for the faint of heart, or for the not for weak-wristed people, because you'll have trouble just being able to pick the thing up. So it's an absolute beast of a book. But it's, I say without trying to sound remotely controversial or exaggerating, it's perhaps the most important book I've ever read. And as you say, it's very good on, it covers a myriad of different topics. So it touches on the truth behind 9/11, discuss truth behind the moon landings, discuss truth behind the pandemic, discuss all these points, some of which are recent, some of which are further back in time, further back in history. But it's very good on two things. It's very good on the requirement to invert, always invert. So whenever somebody, and I think Charlie Munger, Warren Buffett's right-hand man, would absolutely go along with this, which is, if you really want to understand a narrative, flip it around and see if it makes more sense as its opposite. So if you don't believe the government narrative on something, turn it around 180 degrees and see if it makes more sense the other way around. The chances are it does. He's also very good. Fergus is very good at helping. He's very good on the psychology of debate and helping people to be open to having their minds changed without alienating them. He talks about this factor called, basically, I think it's the pushback. That if you go to someone and say, "What do you think about X?" and they say, "Oh, I believe this," and then you go, "Ha ha ha, you're completely wrong. You're a stupid fool." That's not going to win the argument. It's actually going to lose your friend. So
and very, very likely solidify their
exactly
position,
and solidify that position that they had before. So if they believed it acutely before, they'll believe it even more strongly now. So he's very good on the whole psychology of how to gently start talking about topics in a way that doesn't alienate your audience, doesn't alienate your friend or your contact or whatever. It's very good on that. So I'd recommend it for that reason alone. But the topics are so wide-ranging in scale, and there's a fair amount, to be fair, that's also dedicated to the world of finance. The other book I would refer people to, if they haven't already come across it, is G. Edward Griffin's The Creature from Jekyll Island, because so many of the world's problems today can be traced in origin to the central banks that are pulling the strings of the financial system. And as we were talking about before we came on air, I strongly suspect that if you asked 100 people what the US Federal Reserve was all about, perhaps not one of them would say it's a private banking cartel. But the Fed is a private banking cartel. It does not serve the interests of Main Street. It serves the interest of a handful of Wall Street firms and nobody else. And you saw that in spades after the collapse of Lehman. The whole system should have reset because everyone was insolvent. The reality was that everybody other than Lehman got bailed out. So you had a massive wealth. Does this sound familiar? A massive wealth transfer from people at the bottom of society to the people at the very top, what we just lived through for the last 3 years. So those books combined will give you a fantastic insight into how the world really works at the level of monetary economics.
And I think those two books combined will also fill up a good half of a bookshelf, because they're
absolutely,
both
yes. If you're living at altitude, you may need to have your floors reinforced.
Well, Tim, I think that was a really excellent conversation, covering markets, covering how they work. And then, just the idea of being able to somewhat change your mind and being open to new ideas, because at the end of the day, I think it's extremely important. And that's something that I always try to, let's say, review a little bit on the show, is the idea that we need to be able to evaluate our own ideas and make sure that we're not missing something.
You need to be comfortable being taken outside your comfort zone. And it sounds like it's an impossible thing to do, but if you can get there conceptually, then the reality is that your processes, whatever the processes may be, will almost certainly be stronger and more robust as a result of just being challenged, because nobody has all the answers.
Well, nobody has all the answers. And, just even realizing that getting outside your comfort zone maybe won't kill you ends up showing you that is okay to step outside of it, right?
That's the sort of the great irony of investing, isn't it? That, as human beings, we're hardwired to seek the comfort of the herd, because that's an evolutionary learned advantage that those people who are removed from the tribe tend to come to a sticky end. But as investors, it's invariably the opposite. That if you can put it this way, if the herd's going over a cliff and you're not with them, there's something to be said for that.
Absolutely. Well, Tim, that was an excellent conversation. Is there anything else you'd like to add before we wrap up here?
Not that I can think of, Tom.
Excellent. Of course, you write a good amount of articles over at pricevaluepartners.com, and your Twitter feed is excellent as well, at Tim Price 1969. And if anybody wants to check out your guys' podcast with Paul Rodriguez as well, it's called the State of the Markets Podcast.
Thanks once again for having me, Tom. I thoroughly enjoyed it.
Absolutely. I enjoyed it a lot as well, Tim. Thanks so much.
Thanks.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.